So, so let's jump straight right into it. So firstly, today we're going to be discussing
Okay.
about liquidity pool and other block jump. So basically these terms are actually not new in the market. A lot of traders usually understand how price usually move in the market. So are you aware of the word market makers? So market makers are basically the people who control the forex markets, the hedge
Yeah.
funds, banks, all those large corporations. So basically, they tend to trade, they tend to make the markets move in a certain way. And so definitely with time you get to understand how price usually moves within a time frame in the market. So first is called the order block jump. I just added jump there because of the way the market usually moves when it approaches these levels. So, by as you can see, what I wrote there, other block jump, these are levels where price tends to react to extensively when price approaches there. So, price always changes direction at these levels. So, in essence, what it means is that the market tends to move to accomplish an objective. So first, before we get into liquidity pool, what we can do is I want to show you how that looks like in the charts. You get me? So first of all, as you can see price here, I'm going to show you examples on both on GBP USD and GBP USD and gold. So looking at price here, we all know that price is still bearish. When you go to the higher time frames, you can see that price is bearish because we have been continuously creating lower lows and lower highs. So obviously you'll be looking to sell the market, of course. So when you head down to the lower time frames, you can see that price tends to form a set. I usually like to call this a decoy in the sense that the market is selling, but you can see price usually creates a different candle within that trend. So it's like a trap, like others have been created here. So let me break it down for you so that you understand, like in a layman term. So these two candles here now is open orders, like orders that these market makers created so that if price comes back here and closes, the markets can continue to trend to where it's supposed to trend to. So when price got to this level here, you can see that the price started to shift to the downside. So these two blue candles here now are trades in which market makers created in order to come back to this level, so as to create a sort of an open position so that when price comes back here they can easily close when price move back down to the direction they actually want price to go to. So what it means is that this order here now, after all this sell, these two candles here now, what it means is that the the market makers are currently on a loss in price here. So they created this order to confuse you to not sell the market. You understand? So if you see two blue candles now, if you're a retail trader and you see two blue candles, you might
Yes.
not want to sell the candle because you feel like, oh, I think the market is going to change. So there are many scenarios that this can happen. As you can see here, there's another one here. Immediately price got there, it changed direction. So this price now, this candle here now is currently on a loss for the market maker because they actually want the market to trend downwards, but they created this decoy now to manipulate you to not sell the market. So when you start to buy, you're going to lose money here, while they obviously they will be losing money as well, but they have a lot of money, so they are not going to close the trade immediately. That trade is still going to be open because the way price moves structure, once you understand structure, no matter where price moves started moving from, price will always tend to come back to that level because this order now here is currently open. So once once the retails are being liquidated out of their position, you can see that price tends to move back to that place. And when it gets there, you don't usually cross this level. You might cross it, maybe come back to this level. Let me use this draw. Price might come to this area and manipulate a little bit, but it will always come back down. Do you understand? So what is happening there is price.
Yes, yes,
So this order now would have been closed when it gets to this point. You understand? So the market makers now have made
yes.
profit from this move to this move downwards, and this order now, which was open previously, will be closed immediately price gets to this place and comes back here. So that's basically what happened here as well. So it moves with an objective. So the objective is to continuously create lower lows. So if you see certain moves like this in certain areas, you're supposed to understand that price will always come back to that level. As long as the trend, you understand where the market is trending to, you will always come back to that trend. Price will always come back to these decoy levels where price will react to extensively. So that's why it's called an order block, because this trade here, this decoy here has been left there so that when price comes back there, you can have the advantage or the confidence. I like to use the word conviction to place your trade here, because all you have to do now is, from a trading perspective, you can just come here, you can place your shorts there. You can even have your stop loss at this point here, or you can leave it here and leave maybe your take profit here or here. So depending on how the market moves, in certain trades, you might get a clean cut where price will just depress downward immediately. I can show you example, but in your leisure time, you can also check and see those moves. So now let me show you another one on GBP USD. So the same thing that happened here. As you can see, price price was supposed to drop, but it created a blue candle here. So immediately price came back to that level. Even after price dropped extensively to this low, it went back to that high. Imagine, and the price is
Okay.
actually bearish. So in the market, you have to be dynamic. You might not, you might, you should not think that price will never go back to a certain level because maybe we're in a downtrend. Of course, from this point where we hit a resistant level, so obviously we're expecting price to depress to downside. So you see the blue candle there to confuse you retailers not to trade. So price came back to that level, and guess what happened? Immediately price he didn't even cross it extensively. It started to drop and it created a new low. So imagine you didn't take this trade from this point and you waited for price to come back here, and you decided to short the market around the what's it called, around the break of that structure at that level. So you can have your entry at the break of structure. I should open it so you can see it very. So you can have your entry exactly at the break of the structure where price is about where price when price touches the other block. So you can have your stop loss here. As you can see, guess what? Look at your stop loss, 9 pips. Is that not amazing?
Yes.
9 pips. So
Yeah.
you'll be able to
Actually took this trade day
you,
person.
you take this. Okay, good. So you can actually see that you'll be able to you'll be able to make a lot of money while you do this. So since you understand this concept already, we should move directly to liquidity pool. Let's go back to gold. So that's basically how you can trade order block or OBG, as well as what I call it, order block jump. So liquidity pool
Okay.
now is not too far from not too far from what other block means. So liquidity pool is a form of market movement in which price take out certain levels to gather momentum to push the initial objective. Hence, price moves to close positions of retail traders for the bigger move to happen. So what that means is that sometimes when we're in a particular trend, you can see price tend to move sharply to certain levels so as to take out a lot of traders from taking trades. You understand? Maybe if you're trying to buy the market and and price just dropped 10 to 20 pips out of nowhere. So that's a liquidity pool. It's trying to gather momentum to continue its move to the upside
Okay.
or to the downside. So this is what happened here. I since you trade GBP, so I believe you saw this move. So the liquidity pool usually happens faster due to news and some some fundamental reasons as well. So this is liquidity pool. So as you can see, what happens here immediately, price was supposed to move downward, but after the news, we got a move that came up to this level. This is a liquidity pool. So obviously, price is not supposed to actually cross this level. Price is not supposed to cross this level if we're still going to remain in a downtrend overall. So we're not supposed to cross this level, but it did. It crossed that level to take out retail traders who started to short the market early. You understand? So immediately price gets here and
Yes.
it fails to create a support level here, whereas so that price can maybe, if price pump to this place and come back down here, turn here to support, the market obviously will continue rallying up, but it came back down within that range. So we're not expecting we're not expecting price to go higher. All you have to do is wait for the market to come back within the range and you sell it back to the lows. So it's quite simple. You place your trade, you place your short position here and just wait for the market to show you where you're supposed to take your profit. So you can take it at the mid range level or you take it at the range low. So that's that's basically that's basically how to trade when you see the market move in certain ways. So it's also the same thing we here as well. So we're expecting price to when price came to this when price was here, we're expecting a sort of move maybe to the downside to create a new low here. What happened was price started to spike to the upside. Immediately price came back here. It grabbed liquidity. It spiked up to this level, thereby taking people who started to short at this level. And if you decided to maybe you didn't want to close your position, you wanted price to keep on going down, you're going to be surprised when price comes back here and take you out. So it's really important for you when you trade, you take your profit and you leave the market. You don't you should not stay in the trade longer than you're supposed to. Do you understand? So immediately price came back up there. Obviously, we knew that it was going to create a new
Yes.
low, but it wasn't going to happen immediately. So that's how to trade liquidity pool. There are many other examples. I think I have one in
Okay.
GBP USD. Yeah. So you understand the concept, yeah? Are you familiar with the liquidity pool?
Yeah.
You're familiar with it
So I
too.
wanted to ask one question.
Okay, ask.
Must it always be in like the liquidity must always be weak candle, or can it just be a close candle?
Um, it depends on where you are in the market. Depends on where you are in the market, but most at times The weak candle here was as a result of the news that happened. The news that happened on was it
Okay.
Friday? Yeah, or that happened on Friday. So basically, I think was it CPI? I'm not sure. I think it was relating to dollar, but I can't remember. But when price moved within a single candle. So if maybe it's in situations where there is no news, obviously the candle can create price can create three candles here, maybe this one, two, three, another one up here. So all you have to do is wait for that candle to close, the last candle to close. But it
Okay.
happened, news motivated that move. So motivated that news. That's why, as you can see, price when price got above the range level, it was unable to create another candle there because all the moves happen really fast. So it depends on what caused the catalyst that caused price to move. So if it's news or a random movement in the market, obviously we can create one, two, three, even four candles within the 5 minute time frame. But news make things happen really fast. Initially, I was expecting price here to come and manipulate above this high here,
Okay.
but news made it happen so fast, and that is why you can see immediately price got to this level and it created another candle above, but it was unable to close. That is why this candle turned into black and came back down within the range. So that was the opportunity for you to start shorting the market. So it depends on where you are in the market, the time frame, and the catalyst, be it news or whatever. You understand? Fundamentals are very important in the market as well. So you have to
Yes.
understand that things actually control the movement of this foreign exchange market. So apart from news, normally, if you're focused on your technical analysis, you just have to focus on structure and know where you are in the market. Do you understand?
Yes. Yes.
Okay, all right. Do you have any other question?
Okay. No. So I wanted to ask one question. So like this liquidity pool, the entry now more just like you wait for the second candle to close, or how will you be able to spot it? Must it just be always above the market structure, or can it be in between candles?
Yeah, it depends on how you like to trade actually. Like I like to trade range to range. You understand? So price from here to here is actually price from this level, sorry, from this level to this level is actually in a range already. So this is another range on its
Yes.
own, and this is the higher time frame range. So you can see, let me clone this. This is another range entirely. So since price moved from here to here, obviously we're expecting here to be touched as well because if it acts like a range, you have to treat it like a range. You understand? So when price move in a range, it tends to move from high to low, high to low, high to low. So that's basically how I trade in essence. So if for instance now let's give a scenario where maybe you're here and news came out that dollar is now strong, or something like maybe CPI print came out positive for the dollar. And when dollar is positive, obviously gold, GBP USD, Euro USD will crash. So maybe dollar came out strong and it started to crash, and you're here. Obviously, you will take the trade. Just you just have to, like I always see, it's it tends to be where you are in the market. That's the most important thing. So if I'm here and I see the move happen, obviously I'm going to take the trade. And if I'm here as well, I already know that there's demand at this level, not even needing to draw this line. I know that there's demand here. So immediately price gets here and it doesn't cross this level. Obviously, I will definitely start to buy the market because news made price get to this level. and we haven't really manipulated this high already. So obviously, when price comes here, I will definitely think that okay, at least I can long the market, which I did. I actually long the market to this level, and when I got to this level, I took out profit. You understand? So I can have my stop loss just about here, and I long the market to this level. I took it out. I also longed GBP USD when it came down to the lows. So that's basically, you just have to know where you are in the market. Obviously, you're going to take this trade, you're going to take this trade, you're going to take this trade when you see it happen, you're going to take this trade when you see it happen. So it depends on where you are in the market. Not necessarily it has to be at the range highs or the range lows. So if you are confident enough to take the trade mid range, anywhere that you feel like price is going to react to, you take the trade. Most important thing is you know where you are and you do the opposite of what retails are thinking. When a normal retail trader see the market is falling, they'll obviously want to sell the market. And when they start to sell the market is going to change character and starts to buy. They lose their money. They lose money. You understand? So that's basically what you do in the market. So do you understand? All right now. All right now. So since you understand the concept and you understand the definition of these two terms, next we'll be moving to our next topic. So
Yeah.
that will be next week.
So I wanted to ask a question.
Okay. So good. You can ask your question.
Okay. Yeah. Wait. Like I should always look out for liquidity profile enter any trade, or if I see confluences, I should just enter.
Confluence is the most important thing. The liquidity pool we should be a confluence for you to enter a trade as
Must I
well.
always look
So
for
must
liquidity
no
profile
no
enter any market, or I should always wait for confluence to enter?
confluences can be anything. It can be liquidity, it can be order block, it can be trend line, it can be whatever. As long as it gives you the confidence to enter a trade, you take it and you understand structure. You understand? So it doesn't mean that liquidity pool doesn't usually happen always in the market. You understand? This happen due to news, and I think one happened before after the news actually for GBP USD. So it doesn't always happen. It doesn't always happen, but if it does, it's good because price tends to move really fast after it happens. So you just have to be instinctive. You understand? You just have to be instinctive. So when you see it, you
Yes.
take the trade. So it doesn't always happen. That's why it's called conferences.
Okay.
You need a lot of criteria for you to be confident enough to enter a trade and hold that trade. So that's basically how you should view the market, not waiting for other blocks or liquidity pool or even maybe a trend line. That way you get to lose money because you're waiting for a particular thing to happen. So if that thing doesn't happen, you won't take trades and you might be deceived sometimes when it happens in places where whereas it happens so that to confuse you. You understand? So you just have to understand that you shouldn't be you shouldn't be closed in a box when trading. You should always be open to changes in the market. And that is what I'm trying to teach you. I'm teaching you to be dynamic in the market so that you can be open and ready for anything that happens in the market. So obviously when price was around here, I didn't expect it to come to this level. But a lot of traders will see it, will know that, oh, this is just a fake out and it's going to come back down to the range. So they can even start placing trades above here and here and here and here, as long as, or you can wait for it to come back inside the range, and you can place your trades here and just hold. You understand? And you can have your stop loss here, here, or here. You understand? So that's basically how you should trade the market, not be boxed in one type of trade. Do you understand? You understand, yeah, Victor?
Yes, yes.
All right. Is there any other question?
Yes, I get the point. Yes.
Do you have any other question, or we call it a day?
No, I understand this one very well.
All right.
Yes.
All right. All right. All right. So it's all good.
The strategy used in entry to enter a trade.
Mm-hmm.
The strategy used in entering trade. Uh, though if I can learn that one very fast, it will be okay for me.
All right. That we'll get into that. We're getting to position and fees. That's where I'm going to teach you how to enter trades and place your stop loss. So yeah, definitely we're going to get into that
Okay.
one. That will be, I think, should be next week. So don't worry. We're going to talk about it. I think that
Okay.
should be the most important thing for you as well.
Yes.
Yeah. All right.
Because but this liquidity pool, I have knowledge about it very well. Like
Good.
I used to
Good.
see
Good.
it on
Good.
even GBPS. There was one yesterday.
Good. That's good.
I saw one yesterday and I actually took the trade on my trade view. 20 well.
All right. All you have to do is replicate what you have learned on TradingView and put it on your MT4. So as you replicate it as well in your live account. So that's the most important thing. We're here to make money. It's all right. Let's call it a day.